glorious, beautiful Colorado day. Those of you who've joined us for the previous Aging at Altitude expos and seminars, remember that we held them at the JCC in Boulder. This year, the times are certainly different. So for the first time ever, we're hosting a virtual expo and webinar series. My name is Al Manz. I'm President and CEO for Prairie Mountain Media, publisher of the Camera, and moderator for today's event. First, let me welcome everyone today to our 9th webinar in the series. It's one of my favorites: financial wellness, estate planning, and reverse mortgages. Before I introduce today's speakers, please notice the Q&A and chat boxes at the bottom of your device screens. Now, you can enter your questions or chat anytime during the presentation. The speakers will speak for about 40 minutes. That'll give us about 20 minutes for what we hope is a vibrant question and answer session. Before we get started, let me remind everybody that they can go to dailycamera.com/aging and visit our virtual expo where you can support our partners. Now let's get started. Joining us today are Diedre Braverman from the Braverman Law Group and Gabe Bodner from Fairway Independent Mortgage. Like I said, they'll speak for 40 minutes, and to get us started, Diedre Braverman will kick us off.
Okay, hello everybody. I'm gonna share a PowerPoint with everyone today and talk through it, but I hope you do ask questions because that's how you really learn what you need to know. So let me put the PowerPoint up on the screen. Okay, we're going to talk about gruesome estate planning mistakes. Just things you don't want to have happen to your estate for your family. Oh, my arrows are not changing the pages now. They did during, oh, there we go. Okay, so I'm just going to introduce myself briefly. I went to Stanford Law School for my undergraduate. I went to University of California, Irvine, and for a while I knew how to read Latin and Greek. That's no longer the case. It's been too many years. I've been quoted in the New York Times, the Wall Street Journal, Time Magazine. I appeared on Fox Business News. I've been planning estates for over 20 years. I started when my twins were born, and they're over 20 now, because I wanted to make sure that they would be protected no matter what. My husband, Ben Braverman, is my partner at Braverman Law Group, and all we do is estate planning and probate work. That includes conservatorships, guardianships, estate taxes, trusts, and wills. And I love bakery treats. They're my weakness. So if it's a croissant, I'm in trouble. Okay, so our first mistake is dying with no will. That's called intestate by lawyers. And what it means is your assets will go to the people the state chooses, not the people you choose. So it's important to make a will or a trust to direct where your assets are going to go. Having an I love you will isn't too much better. That's a will that just says, I love you, spouse, and I'm going to leave everything to you. It works for the spouse, but when the spouse dies, it doesn't say where the property goes after that. The other problem with an I love you will is because it's not a trust, it goes through probate. Probate is the court-supervised process of transferring assets from someone who has died to the people who are entitled to inherit them. And because it's a court process, it requires filings and fees, occasional hearings. It's a lot more work for the person you choose to administer your estate. Now we've got a reason, we've got a reason to make an estate plan. Elaine, your husband's next wife. In the month since your death, she's brought your husband home-cooked meals 6 times. She's wearing a skimpier outfit each time. She's got plans to redecorate your home, and she's also got plans to spend your savings on jewelry and spa vacations. With an estate plan, you can protect the assets you leave to your spouse and children from other people interfering. Owning property jointly is a common mistake. People think that if they own their house, joint tenancy with right of survivorship, they've taken care of the estate planning for that house. But there are 2 big problems with that. First of all, what happens when the second person dies? It goes through probate. And if you don't have a will, it goes to the people that the court chooses. And the other problem is, what if one of you becomes incapacitated? 80% of people become incapacitated at some point in their lives. And if a spouse becomes incapacitated, the healthy spouse cannot mortgage the home, can't do a reverse mortgage, can't sell the home and move someplace smaller or into a retirement community. All of that would require the court to get involved with something called a conservatorship. And a conservatorship is a lot like probate, except it happens every year for as long as that person is incapacitated. So conservatorships are not desirable. If you use a revocable living trust instead of joint tenancy, your house will still go to your spouse entirely. But if your spouse becomes incapacitated, there's no need for a conservatorship. You just take over managing the house on your own. It's 1 piece of paper in the attorney's office. And when both of you are gone, the trust says where your house goes, so it doesn't end up going according to state rules. Here we've got the Farkles. The Farkles, your daughter's in-laws. They're the kind of people that accept invitations to dinner without ever reciprocating. They like to hang out at the house you bought for your daughter because it's nicer than theirs. And Big Al, who sells RVs, can't have a conversation with you without mentioning it. Do you want them to enjoy your daughter's inheritance? And what can happen is you can leave money to your daughter, and if something happens to her, it could go to her husband if she doesn't have an estate plan. If something happens to him, it could go to his parents if he doesn't have an estate plan. So an estate plan really ensures that your assets go to the people you choose, not just at the first level, but at several levels, so that when someone dies, it goes to the next people you want it to go to. Take a sip of coffee. I hope you all have coffee. Okay, if you have a living trust has pros and cons. The pros of a living trust are it avoids probate, which means your beneficiaries' names and addresses are kept private. They don't go into the public record. It means your assets are kept private, and those don't go into the public record. So your beneficiaries don't get flooded with flyers and sales calls, and sometimes scammer attempts. Scammers will see that someone has inherited a lot of money and take their chances trying to get at some of that. So the living trust has all those advantages. It's also faster to administer than a will, because a will goes through probate, so you have to wait for the courts. It's 30 days before they'll even look at the will. then you get an order, then you have other hearings. With a revocable living trust, you can get control of the assets in days. So it's much faster. It's also easier for the person you choose to administer your estate. So if you've chosen a child or a brother or a sister, the living trust will take them a lot less time than a will going through probate. But the downside of a living trust, there are two downsides. One is that living trust costs more than wills to set up. The attorney's fees are higher. And the other is that you have to actually transfer all your assets into your living trust to make it work. The way a living trust works is when you die, nothing goes through probate because you don't own anything. Your living trust owns it. And your living trust says if you die, someone you've chosen takes over managing that trust. Generally, it's your spouse if you're married, and then it could be a friend or a family member, or there are banks and trust companies that will manage your trust for you. But they can't take over unless all your assets are in your trust. So when we do an estate plan, we prepare a deed to transfer your home and any rental properties into the trust. And we give you written instructions on how to transfer your bank and investment accounts into the trust. We need to get everything transferred in to make it work. Funding is the term for transferring assets into your trust. So you need to fund your living trust. Now we've got Marvin. Oops, I don't know why he keeps going too. Marvin is a serial entrepreneur. He started 16 businesses, including multi-level marketing schemes and real estate deals, and they've all failed. He's gotten you to back each one. He's gone through bankruptcy a couple times, and he owes a ton in legal fees and back taxes. If you leave your money to Marvin, it's just going to disappear. But you may not want to disinherit Marvin. After all, he's your son. So you leave your money to Marvin in a trust with someone else as the trustee to manage the money. So Marvin can't waste it and spend it on crazy ideas. You give the trustee some guidance about how distribution should be made to Marvin. The most common language is Marvin can get maintenance, education, support, and health. And that means that Martin can have all of his living expenses paid for, including tuition, medical expenses, a new car, a vacation. The trust could also buy a house for Marvin. So although the trust keeps Marvin's fingers out of it, it's very flexible. Now, if you have a child who's not like Marvin, who's responsible and can handle their own money, you may still want to make a trust for them because the trust protects against divorces and lawsuits. But with a responsible child, you would put them in charge of the trust. They would make those decisions about how to invest the money, how to spend the money. It wouldn't be a third party. It would be your child themselves. But as long as they kept money in the trust, that money in the trust would be completely protected. Okay. You do need to review and update your documents. I know some of the people out here watching have done plans that are 5 years old, 10 years old, 20 years old. The laws change and your life circumstances change. Estate planning is very customized to the person or couple, their values and goals, and the people that they trust. So if you haven't reviewed your estate plan in 3 to 5 years, I strongly recommend you take a look at it. We offer free consultations for people about their estate plans, whether they've done one before or not. So you can call us, Braverman Law Group, and schedule an appointment, and we will review your existing estate plan and make recommendations on changes for you to make. Now we've got your son, oh, went on an extra page. Your son-in-law, Fred. Fred isn't conventionally employed. He belongs to a cult. He sells t-shirts for a band. You think he's very fond of chemical substances, and he thinks it's great he has rich in-laws. So this is where the trust for your daughter can protect her assets from Fred. Fred won't be able to access them. If they get divorced, Fred won't be entitled to any of them. And Fred won't be able to spend any of them. Only your daughter will be the trustee. Okay. Thinking a living trust alone is enough is the last mistake we're going to cover today. And I've got a lot of documents written on this page. These are all documents that we include with trust plans that we create. The family meeting is a meeting with the people that you choose to manage your estate and your beneficiaries, your children or siblings or other beneficiaries, to explain to them what their responsibilities are. And we can have that meeting with everybody in your plan or just one person in your plan. Oh, you need a will, even if you have a trust, because it's possible you might leave something outside of your trust, and the will transfers that into your trust. It goes through probate, so we don't want to have to use it, but it's there just in case it's needed. You also need a healthcare power of attorney. That tells doctors who you want to make decisions for you if you can't make them for yourself. You may want a living will. That expresses your wishes about end-of-life care. It says, if I'm in a persistent vegetative state or a terminal condition, and 2 doctors have said there's no probability that I'm ever going to recover, then I want life-sustaining treatment removed. We also prepare for you, it's not on here, a HIPAA release that authorizes your family to get your medical information. And then we send all 3 of those documents to a service that sends you a 24/7 emergency wallet card. That wallet card goes by your driver's license. And if you're ever taken to the hospital unconscious or without your documents, you don't have time to get your documents and you need them, that can all be faxed right away. The hospital just has to look at your card, call the number, and enter your PIN code. We prepare a personal property memorandum that allows you to say who will get your specific items like your wedding jewelry or your mother's painting after you die. And you can fill that out at any time. There are a lot of other documents on here that I won't go into, but it's all arranged in a binder, tabbed with all kinds of guidance to help you find what you need. Okay, the biggest enemy is not probate or even taxes. And I'll say about taxes right now, most people don't have to worry about estate taxes. The exemption, the amount you can leave without tax, is $11.5 million. That may go down if Biden is elected because his proposal is $3.5 million. But the biggest enemy is not planning at all because there's so much we can do for probate and taxes. Nothing is so fatiguing, at least to me, as the eternal hanging on of an uncompleted task. So I invite you to call us and schedule a free consultation today. I will offer one other thing. We have a family asset protection guide, which is about 30 pages on estate planning. And for those of you who aren't ready to schedule a consultation, it might be a nice introductory document for you to just get familiar with estate planning. That's all I've got for you today. Thank you for attending.
All right, Al, would you like me just to jump in at this point in time? All right. Well, it looks like I've been given the go-ahead by Al and Diedre. Thank you for that information. That was really very, very valuable. So again, thank you for that. Again, my name is Gabe Bodner, as Al mentioned. I'm going to share my screen with you at this point in time so you can see my slides. Give me just 1 second to do that here. And go into presentation mode. All right. Now, can I get a thumbs up that you see my slides okay at the time? All right, awesome. So thank you all for that. So going backwards, just to tell you a little bit about what we're going to do today, I put together a quick agenda. So first, I'm going to tell you who I am, a little bit about my background. Then we're going to jump into the reverse mortgage basics and benefits. There's a lot of information I'm going to cover today, and I only have 20 minutes, which is not a lot of time. So I'm going to go fast and furious. Stay with me, and we will have plenty of time at the end for questions. So again, if I go too fast for you, please know we will get to some questions in the end. We're going to talk about different ways of what I call harvesting cash from home equity. We'll talk about 3 buckets of retirement and the sacred cow of home equity: safety, important changes, and a paradigm shift. What I call a paradigm shift in how you should think about utilizing a reverse mortgage today versus how it was utilized in the past. And then again, some examples of how to utilize a reverse mortgage. So with that, I am the producing branch manager on 29th Street in South Boulder for Fairway Independent Mortgage. I'm also an adjunct professor at CU Leeds where I teach real estate finance. And that's something I really enjoy doing in my spare time, if you will. I did graduate from Leeds Business School in '98, and I was in Army ROTC while at CU. So that allowed me to get commissioned as an officer into the Army. Spent 4 years on active duty and then 4 years in the Army Reserve. But when I got off active duty is when I actually got in the mortgage business. So I've been in the mortgage business now 18 years, originating, and have closed over 1,500 mortgages. Very happy to say I live in South Boulder with my amazing wife and my 2 boys who are 13 and going on 15 right now. So that's a little bit about me as your presenter today, just so you know who I am. Now let's jump into some reverse mortgages. This is my definition of what a reverse mortgage is. And I've underlined a few key elements here, but I'm going to read it to you. But a reverse mortgage is a payment optional mortgage that allows homeowners to maintain homeownership, convert a portion of their home equity to tax-free cash, and never have to make a mortgage payment for as long as they live in the home. Now, again, I underlined a few things there. We're going to dive into these now, but a few key elements, once again, people don't realize the number one misconception with reverse mortgages is that the bank now owns my house. That is absolutely not true. That's the furthest thing from the truth. You still own the house, you still maintain ownership, and you can still pass that house on to your heirs as part of your estate plan. So let's jump into a few other things. You have to be at least 62 years of age or older to qualify for a reverse mortgage. So I'll tell you right now, I'm not 62 yet, but the day I turn 62, I will absolutely be getting my reverse mortgage. I am a huge proponent and a huge advocate of reverse mortgages. The home itself has to be FHA qualified. Well, what does that mean? It means it has to be a single family residence, a townhouse, a 2 to 4 unit property, or an FHA approved condominium. So there are some manufactured homes out there that we can also potentially do a reverse mortgage on. And the home has to be free of what we call health and safety issues. So we'll do an appraisal on the home and make sure that it meets the FHA standards. Additionally, the home has to be your primary residence, which means by definition, you live in the home for at least 6 months a year. Okay, you can have another home. You can actually use a reverse mortgage to acquire a second home or a vacation home, but the home that has the reverse mortgage must be your primary residence. Okay, and generally it will not affect Social Security, Medicare benefits. Because I'm not an attorney and because I'm not an elder law attorney specifically, we don't get into the details about Social Security and Medicare and Medicaid, but I will tell you that when you access equity via reverse mortgage, it's considered borrowed funds. It's not considered income. Therefore, that's why it's not taxable. And therefore, that's why it will not impact your Social Security or Medicare benefits. Okay? Continuing on, as I mentioned earlier, you do get to keep title to your home. That is absolutely imperative to mention. I will also say if you hold title in the name of a revocable living trust, you can keep your home in the name of the living trust if you do a reverse mortgage. Basic income and credit qualifications and property qualifications and the amount of equity that one can access is generally between 30 to 74%. Okay, now that's a very large range, obviously, but that range is based on age, current interest rates, and value of the home. Okay, we'll get into a little bit of the weeds here in a little bit on that, but we try to kind of use a general rule of thumb. As you can see, 50% is sort of in the middle of that number. So we say that, you know, if you had, as an example, a $600,000 home, you can borrow about up to $300,000, which is 50% of the value of your home. Okay. And once again, you do not have to make a mortgage payment for as long as you live in the home. You are still required to pay property taxes, homeowners insurance, HOA dues if you have them, and you are required to maintain the home, but you are never required to make a payment back to the lender on the loan itself. Now, with that being said, you can, and I certainly have clients who do that, but you are not required to do that, which is huge. All right. When does the reverse mortgage need to be paid back? Well, it doesn't require repayment until, believe it or not, the youngest borrower's 150th birthday. Yes, I said that right. 150th birthday. Well, we all know that nobody's actually ever lived to be 150 yet. So if you don't live to be 150, well, the loan does need to be paid back when the last living borrower permanently leaves the home, or if you choose to sell the property. And again, if you were to pass away, then the loan does become due and payable. However, one of the benefits of the reverse mortgage is that these are FHA insured loans. Therefore, you nor your heirs can ever owe more than the value of the home. So if you don't ever make a payment and the mortgage balance grows over time because of the deferred interest, okay, and the loan balance were to eventually grow beyond the value of the home, you cannot ever owe more than the house is worth, and you cannot pass that liability onto your heirs. You are protected from that, okay? You can pass the equity onto the house, but you cannot pass the debt onto the house. Another thing I think is important to mention is that you can actually use a reverse mortgage to purchase a home. Many clients right now that we're working with that are actually downsizing or right-sizing their home. Let's say they sell a home, $1 million in Boulder, they go to buy a $600,000 home, okay? Instead of putting $600,000 cash into a house, let's say they take a reverse mortgage for $300,000 and then they put $300,000 as a down payment. So now all of a sudden they get to preserve the cash from that last sale, okay, and use the reverse mortgage to purchase the new home. Another wonderful strategy that a lot of clients are doing right now. So let's talk about different ways if you are using this to refinance your home and not using it to purchase, but if you're using it to refinance your current home, how can you access that equity, okay? Well, there's three main ways to access the equity. Number one is what we call a lump sum distribution, okay? That means that you want a lump sum of cash, right? You own a $600,000 house, okay? And you want $100,000 cash. We can do that. That's part of a lump sum, okay? Number 2 is a line of credit. This is my absolute favorite feature in a reverse mortgage. Okay, this works very similarly to a home equity line of credit that you may be familiar with or may have even had or have today. But the beautiful part about the reverse line of credit is it is non-recourse, as I mentioned before, which means that you can't ever owe more than the home is worth. But number 2, the reverse mortgage line of credit is guaranteed to grow, which means as you continue to live in the house, the lender gives you access to more and more equity over time. So that's right. As long as you continue to live in your house, you have more and more access to the equity, which is a huge, huge value as you, again, continue to live in your house to be able to access that equity. And then third is a monthly payment plan. We can actually pay you as the homeowner every single month as you continue to live in the house. As opposed to paying the lender, now the lender's paying you. And then lastly, you can do a combination of any or all of these. So you can do a partial lump sum, you can do a partial line of credit, and you can do a partial monthly payment plan. So very, very flexible on how you can, what I call harvest cash from the equity in your home, okay? Next, I'm going to talk about what I call the 3 buckets. And the 3 buckets is probably, in my opinion, one of my favorite slides in this entire slide deck. So I'm actually going to pull my pen out here and hopefully you can see this on my slides as I draw here. But if you look at the top half of this slide, okay, this is when we're in our working or earnings years, okay? And I'm just calling it between 18 years old and 61 years old for conversation purposes. And as we're earning an income, okay, we're generating income, W-2 wages, 1099, whatever it is. And if you own a home, okay, you're putting money into this bucket over here. Okay, so this is your income bucket, this is a nest egg bucket, and this is your home equity bucket, bucket 3. Okay, so if you own a home, okay, you're putting money into this home equity bucket number 3. Okay, this is down payment goes into this bucket, monthly payments between the principal, okay, that you pay your lender every month, that's going into this bucket. Now, most financial advisors that you speak to, and I'm not saying they're wrong in this, but when you speak to a financial advisor during your earnings years, what do they tell you? Well, they tell you that you should be putting between 5 and 20% of your income into this bucket, okay? That becomes your nest egg. That becomes your savings, right? So just to refresh, as you're making a living, you're spending out of bucket 1, your income bucket, you're putting money into number 2, your nest egg bucket, and you're building bucket 3, which is your home equity bucket, right? So that's what your traditional financial planning model looks like in our earnings years. Well, as we move to this lower half of the slide and we move into our retirement years, okay, our income is decreased, right? Most of the time, okay, it moves into a fixed income, whether it's a pension or Social Security or a combination thereof, it's usually less than what we were earning when we were working full time. So how do we maintain our lifestyle in our earning years, or excuse me, in our retirement years? How do we maintain our lifestyle? Well, you can either cut out expenses or you can supplement your income from pulling money from this bucket right now, which is your nest egg. And that's the traditional model that we see in our country today, which is as you move into retirement, you pull money from this bucket. The problem becomes, what happens if you didn't save enough, or if there was a recession and this bucket isn't as much as you would have hoped or planned or needed, okay? So what happens is this nest egg becomes your supplemental income where you distribute from. And what happens with most people is this savings bucket, this nest egg, just simply isn't enough. It's not going to last you long enough because people are living longer, cost of living is going up, right? Cost of housing is going up, everything is going up. And then what happens if there's an unplanned event? Okay, where do we cover that expense from? So then people say, well, I'm gonna just sell my house and I'm gonna go live off that equity if I run out of money here. And by the way, 95% of people in retirement, their number one concern is running out of money in bucket number 2 before they pass away. okay? So what the reverse mortgage does is it literally puts a spigot over here, okay, on this bucket, so that all of a sudden you can pull money from this bucket over here to protect and preserve this bucket over here. Because let me show you, as you've been making a mortgage payment all these years, you're putting cash into bucket number 3, right? And as you take money every single month and you put it into bucket 3 as a mortgage payment, that becomes equity. And this equity looks like cash, but it's not. You can't use it. You can't take equity to the grocery store and buy groceries. You can't put gas in your car with equity, right? You can't go on vacation with equity. So what the reverse mortgage allows you to do is it allows you to convert this equity to usable cash. Okay, and in doing so, it's tax-free, and it protects this nest egg so that that nest egg lasts longer. Hopefully, it's in a vehicle or type of account that is actually growing. And so, if you leave that money in there and allow it to grow, then ultimately we're utilizing what I call bucket 3 and bucket 2 strategically, so that 1, you don't outlive your money, and 2, if you use them strategically, according to new research that's come out of the American College of Financial Planning, you can actually leave a larger legacy behind for your heirs. So again, I got a couple more slides I want to cover. I've got some ideas that I want to share, so I'm going to keep going here. But again, this is my favorite slide of all the information I'm sharing today. But I talked about some things early on about how a reverse mortgage is safe. Here's some just bullet point reasons, but ultimately, as long as you, okay, meet the terms of the loan, you pay your taxes, you pay insurance, you live in the house, you never have to pay the loan off as long as you live in the house, okay? There is no prepayment penalty on this loan in Colorado and in most states. So you could pay the loan off early if you chose to. Okay, that's not a problem, whether you sell the house or inherit money and you want to use that. And then once again, after you're gone and after the house is sold, any equity remaining in the home can be passed to the heirs. So once again, this is another option to keep an asset that you can pass on to your heirs. Okay, some changes that have occurred in the last few years that have made this a better, safer program. Financial assessment, that was a wonderful change that happened in the spring of 2015. What we call non-borrowing spouse in the fall of 2014, which really protects younger spouses. So I mentioned at least one borrower has to be 62 years of age or older. Okay, if you're married and your spouse is under 62, okay, they can't be a borrower on the loan. But we call them a non-borrowing spouse, and now with the new rule changes, they're protected. They can stay in the home for as long as they live, even though they may not be 62, okay? And same-sex couples are allowed as of summer of 2015. So some great changes have occurred in the last 5 years, okay? I talked about a paradigm shift. The old days, okay, a reverse mortgage used to be considered a loan of last resort. I want you to now think about the reverse mortgage being best utilized sooner rather than later, okay? Sooner rather than later, and here's why, okay? You get the reverse mortgage line of credit, and at 62 years old, $600,000 home, you may have about $223,000 available on your line of credit. But let's fast forward, 27 years go by, all of a sudden with a 4% annual home appreciation, your home value, okay, if you look at this green line, might be worth $1,024,000, but because that line of credit is growing, you now have access to more equity in your home potentially than actually exists. This is an insurance policy. This is getting an umbrella before it rains. This is absolutely why I said the paradigm shift. Don't wait until you run out of money in bucket 2. Do not wait until you need this. This is an insurance policy that allows you to access equity in your home, okay, in the future as you continue to live in your house, okay? I just want to talk about the fact that Many people think, hey, I've got a really low interest rate on my mortgage. No problem. Take a $200,000 mortgage, okay, 30-year loan at 4%, you're paying almost $1,000 a month. Okay, I have many clients today who call and say, I want to refinance. I see rates are in the threes. Great. You're still looking at over $343,000 cash. That has to come from bucket one. That has to come from bucket two. That money has to come from somewhere to service a traditional, or what I call a forward mortgage. So that reverse mortgage allows you to save, in this example, over $343,000. Okay. A few other slides real quick, and then we'll get to some questions. But reverse mortgage, again, some examples, can be used as a long-term insurance or to cover long-term insurance premiums. It can be used to cover life insurance and life insurance premiums to allow you to leave a larger legacy behind. Okay. It can be used to cover the Medicare gap from age 62 until you qualify at age 65. I've seen, unfortunately, especially in the times that we're in right now with COVID, unfortunately, people have been let go. Unfortunately, people age 62, 63, 64 have been let go from their jobs. They no longer have health insurance, okay? It's hard to get a job in today's economy at 63, 64 years old, unfortunately. This could allow you to utilize a small portion of the equity in your house to cover the insurance gap before you qualify for Medicare, okay? Last two slides, and then I'm gonna wrap up, okay? Number one reason to use a reverse mortgage, refinance a standard mortgage to eliminate monthly mortgage payments, okay? Absolutely the number one reason. Number two, use it as a standby portfolio protection, okay? Put that line of credit in place. Now you have tax-free funds available instead of keeping cash in a portfolio. You keep cash in a portfolio, you can't make money on your cash, okay? So using the reverse mortgage as a standby protection, okay? Again, replacing cash. We talked about potentially purchasing life insurance, long-term care insurance, another great way to be able to utilize a reverse mortgage. And I mentioned earlier, you can absolutely own a vacation home or a second home using a reverse mortgage on your primary residence. Take a lump sum cash, go buy that vacation home, go buy that RV, okay? Travel and use those funds from your reverse mortgage to live that quality of life in retirement, okay? Gifting to family and gifting to nonprofits. I can tell you a quick story. I've got a client right now who absolutely has dedicated her life to the music industry, okay? And she has told me that she owes that to her college, Pomona-Pitzer College in Southern California. So she's got a reverse mortgage now so that she can create a legacy plan and gift money to Pomona-Pitzer College on her behalf to thank them for the life that she has received through music. Again, another great way to be able to leave a legacy behind while you're alive, okay, or provide that legacy as opposed to when you're no longer around. I know that's a lot of information. I know I went quickly. I apologize, but I am here for questions. If you would like to receive a free brochure about reverse mortgages, please just contact me. There's some information on the screen right here to be able to either email me, call me, or get me on my website. Love to answer your questions. Love to meet with you face to face. And look, at the end of the day, if a reverse mortgage is not right for you for any reason or another, we can also assist you with a traditional mortgage as well. So thank you for your time. Thank you for listening, and look forward to speaking with you soon.
Wow, that was terrific. Both very complicated topics. You guys did a really good job in the short period of time we have. We do have a lot of really good questions, and we'll get into those now. This one here would be for Diedre. My attorney retired. Should I stay with his firm for future needs or make a change now?
That's a good question, and it really depends on your personal preference. There's no difficulty in moving an estate plan from one law firm to another, so you shouldn't hesitate to choose a new attorney if you want. Your attorney who retired presumably chose the people they were in the law firm with, so maybe there's some trust there. But we would be happy to meet with you, regardless of your experience with the retired attorney's firm.
Excellent. This is for Gabe. When you secure a reverse mortgage, is there a normal appraisal done at that time? And can you talk about, included with that, can you talk about upfront costs and interest rates and how they compare, and are they deductible? So there's kind of 4 questions in there, but I think you can get to it.
Yeah, you hit me with a bunch of questions there, which I appreciate. All good questions. So number one, we do a full appraisal. Right now, I will say with COVID, we are making exceptions. FHA is allowing an exterior only appraisal with COVID, but normally we do a full interior and exterior appraisal. As I mentioned in my slide presentation, that we do look for health and safety issues and concerns in the appraisal to meet FHA standards, okay? As far as the fees and upfront costs, I'll tell you that, first of all, these loans, you really can't compare the fees to a traditional mortgage, number one, okay? This is not a traditional mortgage. You can be in this loan for the rest of your life, arguably 15, 20, 30, 40 years, and never have to make a mortgage payment. So these are more expensive. This is more like an insurance policy and a mortgage and a home equity line of credit all combined. So you're getting a lot within this program. With that being said, there's really 3 categories of fees. Number one, you have FHA mortgage insurance, which is 2% of the appraised value of your home. And that has a cap of about $14,500 based on your home value. Number two, we have a loan origination fee. The industry standard loan origination fee is about $6,000. And that's the secondary fee. And then the third category are what we call third-party fees. The third-party fees include your appraisal fee, your title insurance, your escrow fee, your recording charges, your notary fee, all the miscellaneous fees. That range is about $3,000 to $3,500. So when you add all that up, depending on the value of your home, these can range anywhere from $12,000 to $22,000 in total fees. Now, the good news with that, I will tell you, is most clients roll that cost into the loan. So what that really means is that you're now using equity to cover the cost of doing this as opposed to cash, right? So you get to keep your cash, you're using equity to cover the cost, which is arguably not usable anyway. But hopefully, Al, that covers a good breakdown of the fees.
Yeah, and the last question is the interest rates, how do they compare, and are they deductible from taxes?
Great question. So yes, the interest rates absolutely compare to traditional mortgages, but keep in mind the interest rate is all relative if you're not making a monthly payment. However, I will tell you right now, most reverse mortgages are done under the adjustable rate option because that's what allows us to get the line of credit. And those rates right now are about 3.5%. So again, those rates are really good. In regards to the deductibility, mortgage interest as a whole is deductible up to a certain limit, right? $750,000 a year if it's paid and in the year it's paid. So with that being said, if you're not making payments on a reverse mortgage, there's nothing to deduct because you're not making a payment. Okay, so hopefully that helps answer the last part of your question, Al. And with that being said, one other piece that a lot of people don't realize today is because of the 2018 tax reform, standard deductions right now are extremely high, right? You're looking at about $26,000 as a standard deduction. If you have a $300,000 mortgage at 4%, you're talking about $12,000 of interest a year. You may not be itemizing your deductions, which means you might be taking the standard deduction, which means on a traditional mortgage, you might not even be deducting your interest today. So just thought I'd add that in, Al, for some clarification.
Those are great. Now, some questions for Diedre, and I'll combine these two. Question is, aren't inheritance taxes based upon state guidelines? And then can you transfer your home into a revocable trust as suggested?
Okay, so there are state inheritance taxes in states like New York. I think Connecticut has one, but Colorado has no state inheritance tax. So the 11.5 million and the 3.5 million that I discussed, those are for the federal estate tax, which runs around 40% of the assets. And that's 40% of the assets over the exemption amount. So if the exemption amount was 3.5 million and you had 4 million, the tax would be 40% of 500,000, the difference between the exemption and the net worth of your estate. Yes, you absolutely should put your house into a revocable living trust, because that avoids probate and conservatorship and ensures that your house can be managed by the people you trust if you are ever incapacitated or when you die.
And I'll add one more for you, Deirdre. Is you see online promotion all the time for wills and trusts. First of all, are they safe? And what should people watch out for if they're thinking about going online for something like that?
Yeah, we've seen problems with online wills and trusts. They tend to be very simple, which sounds great because you can read it quickly, but that means that there's no flexibility in them. There aren't the provisions you need to be able to do different things. So people end up with these wills and trusts that don't allow them to do what they need to do. And we've seen a lot of that. Attorney-drafted wills and trusts are just a different breed. They're much more comprehensive. I mean, it depends on the attorney, of course. But if you go to an attorney who focuses on estate planning, who makes that their business, their plan should be much more comprehensive and allow your family much more flexibility and assurance that it will work. Sometimes they fail and it ends up in court.
Thank you. We've got a couple questions for Gabe. First of all, can you buy a house or a second home using a reverse mortgage, and how does that work? And how much money do you need to put down? And I'll let you answer that. And then under reverse mortgages, do both spouses need to be 62 or just one?
Great question. Let me take the first one first. And that is, you can absolutely use a reverse mortgage to buy a home. And that is a really, really cool tool that a lot of realtors are utilizing today, or starting to utilize more and more. The amount of money you have to put down is, once again, based on your age. So that down payment can range anywhere from 30% down payment to 70% down payment based on your age. Standard sort of 65-year-old client today is going to be looking at about 50 to 55% as a down payment. Okay. How it works is such that, okay, let's just say you go buy a $600,000 home and your down payment requirement is 50% based on your age. So you bring $300,000 to closing as your down payment, and we, as the reverse mortgage lender, provide you $300,000 as a loan for the other portion of your purchase price. So between the $300,000 and the reverse mortgage, the $300,000 you bring, you've got your acquisition price. But as I mentioned in the presentation, you never have to make a payment on the $300,000 reverse mortgage that we've provided to you. That's the value, is that one, you don't have to make a payment, and two, you don't have to bring $600,000 cash to close to avoid making a payment. So you have $300,000 more cash in bucket two to live off of. Next question now.
And the second part of the question is, does one or both of the spouses need to be 62?
Yeah, so as long as one spouse is 62, you don't need to, the other spouse does not need to be 62. Okay, so only one of you needs to be 62.
Cool. This is a question for Deirdre. Most of my money is in 3 tax-sheltered annuities. My understanding is that them to individuals in my will is a bad idea because of taxes. Is there a better way?
With annuities, each annuity is different. They're based on contracts. So we have to look at the annuity, but generally annuities do not go into your revocable trust because there are tax consequences. You can put life insurance into your revocable living trust, but annuities, you name a beneficiary on them. Another asset that doesn't go into your revocable trust is your retirement plans. You can name the trust as a beneficiary of your retirement plans, but it won't own your retirement plans, again, for tax reasons.
And Deirdre, just curious for people, what is a good range of what it would cost someone to do a will or a trust?
Absolutely. I know everybody's wondering that question, so I'm glad you asked it. It's a range. We have fixed fees. So if you started with our most basic plan, which is a will for an individual person, you'd be looking at $1,400. And if you did a joint trust for a married couple, you'd be looking at $3,700. And most people are somewhere in between those two.
And so what if you had mentioned an update to a current will or trust? What would that run?
Yeah, updates, the cost of the update depends on how extensive it is. If you're just changing the name of your trustee or your executor, you're looking at a few $100s. But if you're changing the heart of your plan, you're adding additional trusts, it can run, it can get into the same realm as setting up a trust to begin with, because you can change it so extensively that it's an entirely new trust.
Thank you very much. That was very informative. Gabe, question about reverse mortgages. When you've been in your reverse mortgage for 10 years, for example, does your lender ever come out and inspect the home? Because you're obviously responsible for maintenance on the home, but you know, do they ever come out and say, hey, your roof needs to be replaced. We want that roof replaced. How does that work?
Yeah, good question, Al. So it works like a traditional mortgage. If you have a 30-year fixed rate mortgage at 3.5%, 4%, has your lender ever come knocked on your door and said, hey, I want to see your roof? Most likely not. Okay. Reverse mortgage is the same thing. In your deed of trust, it says you are responsible to maintain the home, right? The same as a traditional mortgage, the language is the same. In all of my years, I have never heard a client or had a client call me and say, hey, Gabe, some random person just stopped by my house and wanted to come in because I had a reverse mortgage. I've never heard of that happening, okay? But you are responsible for maintaining the home as per the deed of trust.
Can I get a reverse mortgage on unimproved land?
No, you cannot. No, you do need a house on that land, unfortunately, to get a reverse mortgage. We won't lend on just raw land itself.
Do revocable trusts owning your home qualify for a reverse mortgage?
Absolutely. So I would say at a high level, yes, without a doubt. We do need a copy of the entire trust. We want to make sure that, and Diedre can talk more on this, but that the trust actually allows the trustees to encumber property. That requirement must be there in the living trust itself, and that the borrowers on the reverse mortgage are the actual trustees of the trust. Al, you and I can't be the borrowers on a loan and Diedre be the trustee of our trust. That would not be acceptable. But as long as you and I are the borrowers and you and I are the trustees of the trust, it's good to go.
And Diedre, you want to add to that?
Yeah, I just wanted to say, Gabe, that point that the trust is reviewed and it must have the power for the trustee to encumber the property is a great example for the earlier question about using online wills and trusts. Those are the kinds of provisions that you don't have in those very short, simple trusts. and your spouse can run into trouble, or you can run into trouble when you need to take out a reverse mortgage.
That's right. Absolutely. Good point.
We're in the lightning round now. We got to get really fast about answering these questions. Diedre, if you get divorced, can you update your will, or should they start a new one?
If you get divorced, you will need to create a new trust, because in most cases, most married couples create a joint trust. So when you get divorced, you can't use that joint trust. It's for the two of you. But you can amend your will rather than rewriting it. My guess is you would want to rewrite it because there will have been so many changes in your life and priorities. But you can amend an individual trust or a will post-divorce.
Excellent. Last question. All my financial assets have a TOD or POD except my house, which I'm leaving to charity in my will. I have no heirs. Is there still a need for a trust?
The reason you might still want to consider a trust is incapacity planning. If you become incapacitated during your life, and 80% of people do, the people you trust to help you will have to go to court and get a conservatorship to manage that house, to take out a reverse mortgage, or to refinance, or to sell it and move you into a nursing home. So a trust still makes sense for incapacity planning.
Guys, we could go on for a long, long time. We're still getting more questions, but we do have to shut this down. I want to thank Diedre and Gabe for outstanding presentations and terrific Q&A session. I want to remind everybody too that tomorrow's session is on brain health, distinguishing between dementias. So that was we had a brain health seminar earlier this week. This is another one that talks specifically about the different types of dementias. So I invite everyone that's on this, that's viewing today, to join us tomorrow at the same time, same channel. Again, thank you to Diedre and to Gabe, and I wish you all a good day.